Hello, it's Jeffrey Christian, CPM Group. It's almost 10 o'clock in the morning on the ultimate day of November 30th, Tuesday the 30th of November. I want to talk a little bit today about the Turkish lira and gold, and then I'll update the market a bit and talk about what hypothecated and encumbered mean. The reason I'm talking about the Turkish lira and gold is that on Friday, in the midst of all of the volatile financial market activity due to the Omicron variant announcements, the Wall Street Journal had a headline that said that the Turkish government was abandoning the lira and shifting to using gold, or the dollar rather, as the currency of choice in Turkey. And actually, the article got the information right. It was just the headline that was wrong, but the headline sent shockwaves briefly through some parts of the gold market, because all of a sudden it looked like the Turkish lira, the government was abandoning the lira and adopting the dollar as its currency, which has happened in other countries over time. And in many other countries, there's not a de jure adoption of the dollar as the currency of that country, but there is a de facto. So if you go to certain parts of Latin America and even Africa, what you'll find is people don't use the local currency, they use the US dollar. And it's very interesting because there's all this talk right now about cryptocurrencies. And if you go to places like Ecuador and Peru, there are companies that are now paying people in cryptocurrencies. And the pro cryptocurrency people say, yeah, we're moving in that direction. But if you look at what happens is on payday, these people get cryptocurrencies and they immediately convert them, typically to US dollars, sometimes to their own currencies, but mostly to US dollars. So the cryptocurrency is being used by the companies to pay their workers, but the workers are not holding cryptos. They're converting them to dollars because the dollar is still the de facto currency of choice, both in official monetary circles and in private sector economy. So it's not that the Turkish government has abandoned the lira, the people have. And the Turkish economy and the Turkish political system have had a number of problems for many years, and they've gotten much worse over the last year or two. The lira has been dropping steadily. The decline in the Turkish lira's exchange rate accelerated over the last few weeks. It's probably about 80% off from the beginning of 2021 as it is. And the Turkish government and central bank of the Republic of Turkey have, they're not trying to defend it per se. The Central Bank of the Republic of Turkey, as it calls itself, that's its name, actually signed an agreement earlier in November, I believe, it might have been October, with the Central Bank of the United Arab Emirates to cooperate on monetary policy. And that partly reflected the fact that Turkish financial markets are very important in the UAE and really throughout the Muslim world, but especially from, say, Libya through Egypt into the Saudi Peninsula. So the UAE central bank wants to do whatever it can to help the Central Bank of Turkey through these tough economic times. So Turkey hasn't abandoned lira. It hasn't adopted the dollar as its de jure currency. The dollar is being used to store wealth in the private sector. Now, this chart shows you how the Turkish Central Bank had stable amount of gold in its monetary reserves, really going back decades, but into January of 2017. Since January 2017, the Turkish Central Bank was buying gold from 2017 into earlier this year. And the Turkish Central Bank actually has sold some gold to raise dollars to try to defend the Turkish lira from falling, but they've stopped that defense mechanism. But the Turkish Central Bank actually did sell. The blue amount is the gold that actually is owned by the Turkish Central Bank. The orange amount is gold that is owned by commercial banks in Turkey. They're deposits from clients, companies and individuals deposit gold as well as euros and dollars and Turkish lira with commercial banks. And in October of 2011, while the Greek crisis was happening and the ECB did not have the legal authority to help with euro bonds issued by other ECB member central banks that could be used to support the Turkish or the Greek bonds at the time, there was this flood of euros, dollars, and gold into the Turkish banking system. And Turkey, its major trading counterpart was and is the EU. So the Turkish central bank did this genius thing where they said, okay, we have a reserve requirement, I think it's about 12%. And right now you have to, the commercial banks have to deposit 12% of their deposits with the Turkish central bank. They don't actually move it. What it is it's allocated to it on a financial basis. And in October 2011, the Turkish central bank said you can meet 10% of your reserve requirements with gold and 10% with euros and dollars. And that freed up Turkish liras to be lent into the Turkish economy, which helped support the Turkish economy while its major trading counterparts and neighbors were suffering mightily. And it helped them avoid recessionary conditions because of the problems next door in the EU countries. In January of 2013, they upped the gold allocation to 30% of the reserve requirement, saying that the first 10% could be marked to market at 100%. The next 20% would be marked at 80% of the market value. And that's common practice with gold because of the gold price variability and volatility, that you use an 80% mark to market in a lot of private and central bank transactions. You saw this enormous amount of gold and euros and dollars being used to meet those reserve requirements. And that has continued into this year. Now, the Turkish Central Bank has changed some rules. They have phased out using dollars and euros or foreign currencies in the official statement for reserve requirements. And they're going to be going, they had reduced the gold cover, the amount of gold that could be used to meet reserve requirements. They had reduced it to 10%, which is where you see these declines a couple of years ago. Or I'm sorry, they reduced it to 15%, and now they're reducing it to 10%. So they are reducing the amount, which is actually sucking out liquidity in the Turkish economy. Turkey has about 24% inflation right now. So they're trying to combat that inflation and help support the Turkish lira's exchange rate by having a more stringent monetary policy. But they're not abandoning gold. They're not abandoning the Turkish lira. Turkish lira remains under pressure. The Turkish economy remains facing a lot of problems, and that's continuing, and it's going to continue, and it's there. Now, on Friday, gold rose sharply and then came back off. And silver actually declined and didn't really come back up. It came back up somewhat, but it has sort of treaded water at the lower end of its range. And today the prices are strong. Gold is testing 1,800 as we talk. Silver is testing $23. Silver had gotten up to 23.06, I think, and gold had gotten up to 18.02 just before we started taping this, recording this at 10 o'clock. So the metals prices have stayed within their recent ranges. We do think that they are vulnerable to a decline. And one of the reasons why we say that is because the overall US economy is actually in pretty good shape, and a lot of data from employment and unemployment to housing starts and overall GDP and consumer spending. A lot of the data shows that the US economy is in better shape than the pessimism that you might see on the evening news, and you're seeing relatively good economy. That means that there's a pivot away from using gold and silver as a safe haven asset. And you might see, and you are seeing somewhat less lower demand for these markets. Additionally, we're seeing that the price of silver, as I said, came down and didn't really bounce back up. So we're concerned that there could be another leg down in gold and silver prices over the next couple of weeks. Longer term, we're still optimistic about gold and silver, but that's where we are at. I wanted to talk a little bit about what it means to be hypothecated or encumbered. Last Tuesday's video, I responded to a question from an earlier video. Somebody asked me how much of the silver in the Comex-registered depositories was encumbered. And I made the point that the silver that's registered with the Comex regulatorily cannot be encumbered or hypothecated. It has to be freely available silver. The same is true with gold, platinum, and palladium. And then I made the comment that the eligible inventories, the metal in those depositories that meets Comex specs but is not explicitly registered with the Comex clearinghouse, that most of that actually was also unencumbered and not hypothecated. There are a lot of people out there who try to scare folks and tell them that there's not a lot of silver, and the silver that is out there that's being reported is encumbered and it's not really available to the market. And it's a lot of just fear tactics by people trying to sell silver and gold at too high of premiums. And it's not actually true. When I said that, I got several comments, and yes, last week's video saying, well, what about the 100+ million ounces of silver that is allocated to various ETFs that's held in those depositories? That's hypothecated, that's encumbered. And no, it's not. And I realized that probably what it is that people don't quite understand what it means to be hypothecated or encumbered. If I am an ETF and I have silver allocated to me in those depositories, that silver is allocated to me. If I am an ETF, I probably have a charter that says I may not encumber that in any way or hypothecate it. Now, what it means to be encumbered or hypothecated, hypothecating is using an asset as collateral. I've got all this silver in New York and I would like to borrow against it, and I'm giving you the right to claim it if I fail to pay back on whatever loan it is. So I'm collateralizing that silver. I'm hypothecating it. There are different ways you can do it. It doesn't have to be a straight collateralization. There are all sorts of financial transactions that you can do. Once you've hypothecated something, you've encumbered it so that you can't just go sell it. Allocated metal allocated to an ETF is not hypothecated nor encumbered. It's allocated, and most ETFs, if not all ETFs, say in their charter, we're breaking the rules if we hypothecate it or encumber it in any fashion. So that metal is not hypothecated and it's not encumbered. It's allocated to that ETF. And should the shareholders of that ETF decide to sell that silver, it can be sold on a moment's notice because there's no encumbrance. They don't have to go back and say, oh, I want to sell that silver, so I have to unwind that lease, or I have to decollateralize it and put up other collateral in charge. And I realized that the commentaries, hey, you're wrong, Jeff, this stuff is hypothecated and encumbered, probably reflected the fact that people don't understand what hypothecated and encumbered mean. If I own silver, allocated or unallocated, I can sell it anytime I want. If I'm an ETF and I'm a shareholder of that ETF, I can sell it anytime I want. That's not encumbered, it's not hypothecated, and it is available to the market. Something that people should be aware of when they go around saying, well, there's all this silver, record amounts of silver in New York, but don't worry, it's all already encumbered and hypothecated, so you can't really get to it. Oh, yes, you can. You feel free to plug into CPM Group. We sell real research based on real facts, reality-based research and consulting, if you will. We have yearbooks, which are really dynamite books that help you understand these markets. We have a retail investor program, which includes the yearbooks and other information, including silver and gold trade recommendations. We have quarterly open forums, which are question and answer periods. If you are a retail investor program client, you actually have access to ask us questions one-on-one away from videos. Next year, we'll be coming out with our yearbooks April, May, June, pretty much on schedule. We're running gold a little bit later because we usually release the gold yearbook on the last week of March, but because we are involved in the future of gold 2022 with the IPMI on April 7th, ostensibly physical roundtable seminar, we're going to launch the gold yearbook the day before, possibly with a physical briefing, unless the COVID protocols change dramatically. They may change dramatically and change back and reopen by April, we're hoping. The silver report we used to release in the last week of April last year, and this year again we're running it into early May just for scheduling reasons, and then platinum we come out with in late June, the platinum group metals reports. We also will have a PGM seminar online in January, an energy and energy materials seminar in February, and then we will have a silver webinar the week before the PDAC, assuming that the PDAC goes forward with a physical conference again this year. We'll have our silver reception there. You can always go to our website and learn about us. You can buy our Precious Metals Advisory monthly or talk to us about other ways. One of the other comments that we've gotten in recent videos is, you know, this is all great information about how the gold market works, how the silver market works, what's nonsense and what's reality in these markets. Can you talk to us about how you would advise or how you do advise clients to invest in gold and silver? We hope to touch on that soon in one of the final videos of the year as we wind the year down. That's all I have for now. Have a good week. We'll probably do another video on Friday. In the meantime, keep your hands clean, keep your mask up, and take care of yourself and others.